Welcome to the Rand Swiss Protect Capital, Maximize Return. So this is part of our, I suppose it's under the microscope event. So we're taking some structured products and we're having a look at, I suppose the use case scenario. We're going to go through the mechanics of them and essentially how they work. So the agenda for today: first, introduction, market overview. We're going to look at why we've launched these two specific structured products. We're going to look at how structured products work. We're going to do a little bit of back testing, and then we're going to take you through the mechanics, and then of course we're going to answer any questions. Nice part about doing a webinar is that you guys can hit us up in the Q&A or the chat window, and we'll try and answer as we go. Of course, this will be posted on YouTube afterwards, so if you are watching on YouTube, like and subscribe. So in terms of the introduction, if you don't know about Rand Swiss, we kind of work through three different verticals. Securities broking is really where the business started, but we now offer managed solutions and wealth and advisory as well. Here we're talking about structured products. So this is actually in the second vertical. These are products that we create or products that we source as well. So today we've got one that we're creating ourselves and one that we found at Nedbank that is very, very similar to ours, but I think it has a unique use case. And we're going to take you through that. We do see structured products as a qualified investment. It's something that you can't build on your own. I would recommend, if you don't have a financial advisor to guide you around this, we're going to answer all the questions, we're going to take you through it, but of course, chat to your financial advisor. They'll put it in the context of your overall wealth, and they'll tell you where it's appropriate, how it's appropriate, and kind of what quantum is appropriate for you as well. If you don't have a wealth manager, we've got plenty of wealth managers that would be very happy to chat to you, do kind of a financial health checkup on you, and to go look at all the investments and kind of understand whether or not today's investments are worth doing in your personal capacity. As I said, we kind of started in securities broking. We've won a whole lot of awards over the years for it. They've actually cancelled this award now, which is unfortunate, but in about 2 weeks, we're going to find out how we rank in the wealth managers survey. So our wealth managers are now competing in the event under a different name. So that's us. So I think let's set the scene. Structured products, global markets, Verve. Verve always chooses a quote when we do these kinds of events, and you've chosen a classic here.
Yeah, and basically we both thought of the same quote at the same time. Be fearful when others are greedy and greedy when others are fearful. Right now, markets were fearful 3 months ago. Liberation Day, we were down quite significantly. Since then, things have turned around quite substantially, and now we're in almost the middle of extreme greed. We barely see any negative days come through, and we continue to see new highs being hit in the stock market. We're well above 6,000 on the S&P. We're above 100,000 or above 100,000 on the local JSE. These are levels that I want to say that they are unjustified, because historically, if you look at when the market goes up, sometimes it goes up longer than you think. But just as a rule of thumb, you want to be a bit careful when you do see these all-time highs. There are many cases in the past where you could have bought into all-time highs and you can see spectacular growth from there. But you'd probably be better off always buying when things are 20% down, as opposed to when things are hitting new all-time highs. You know what I mean? In the longer term, especially. Now, the thing to understand here is that we're in a very different situation, and I put Trump up here again. And those that watch my weekly articles, wrap up, always listen to me talking about Trump all the time. The reason is quite simple. He's a very different kind of president than anyone else before him. Realize we've only been in the Trump administration for about 7 months now, or it's actually 6 months. It's basically since the 20th of January. It's now about the 20th something of July. This is a incredible amount of uncertainty we've seen in that period of time. And it's going to continue. There's no evidence that Trump ever calms down. Didn't happen in his first term, didn't happen when he was out of office, and certainly not happening in his second term.
Yeah. So okay. I think, with that background as well, given the context of, it has been incredibly volatile year. Everything from, dropping bombs to as I say, tariffs, and I think we have a key risk event coming up now as well, which is the 1st of August, when a lot of these tariffs are going to come in place. But overall, we've put 2 slides up here. These are year-to-date returns. So this is on the global markets, excluding the S&P 500. Markets have been pretty pretty relaxed about the whole situation. I think we both made that's then the S&P 500. We both made the prediction. We always do the first, it was like first couple of weeks of January, we do our big predictions for the year, and I think we said we're going to get a 20% sell-off. We're going to finish positive. So we're looking pretty good on that specific prediction.
Yeah.
But I think there's a long way to go. We're only halfway through the year.
Yeah.
Typically, and I think, the history of sell-offs that we've seen recently as well is that sell-offs, the bounce back seems to come faster than it ever has come before. We saw it in COVID. I mean, sharp market declines, sharp recoveries. We had the same sense in the Liberation Day sell-off earlier this year. There's a very real scenario that I can imagine in which markets fall and it takes, I mean, we both remember 2008. I mean, that was 3-4 years of climbing that wall of worry where it was, is it going to be a V-shaped recovery? Is it going to be a W-shaped recovery? Like looking at the kind of fundamental economics. So maybe, like risk factors that you're seeing coming up. I mean, markets, and also given market pricing at the moment, I know you're in the middle of earnings season, I think the bar is set pretty low. I think earnings are expected to grow just above 5%, which is kind of, looking back, we haven't seen this negative an outlook in probably 2-3 years. But you do get a sense that valuations are pretty stretched on some of these companies.
Look at NVIDIA. It's the first $4 trillion company. We've never had a company hit $1 trillion until about 2019. Now we have $4 trillion company. And the weird thing is, the one that hit the trillion, I think $2 trillion first as well. Even $3 trillion first was Apple. And now we have NVIDIA overtaken it at over $4 trillion. Microsoft is number 2. These two companies are dependent on the AI, race that's happening. Google also in there, Oracle, Palantir. Quite a number of these really big blocks are really dependent on what's happening with AI. We could see a pullback on that because of, a change in technology or whatever. That's just the general marketing, but there's also we have the GNU. We've had issues with the GNU over the last couple of months here. The firing of the DA deputy minister, the fight between the DA and the ANC with regards to corrupt, in inverted commas, ministers. I'm not saying one way or the other. But also, I mean, we have the geopolitical things like, for instance, a possible replacement of leadership in China. We are talking about the possible replacement of the Fed head by Trump. These are all factors that will easily shift the market in a very different direction.
Yeah, it's interesting you bring up the GNU. I mean, from a currency point of view, I did this currency slide in my Global Outlook webinar about 2-3 weeks ago. I mean, the rand has been incredibly strong over the last year. I mean, part of it, I think, this is a US dollar chart that I've got up on the screen at the moment. A little bit of this is dollar weakness as well. But both products that we're looking today are US dollar based products. Even though the one is almost, I suppose it's it's sort of a local product, but both your principal and your return will be linked to the essentially in dollars. And we've also selected dollars. I mean, we ran a pound note probably about a month and a half ago for some clients. But we've selected dollars this time around. I mean, we've seen if we look at the dollar index, about a 9.5, almost 10% weakening in the dollar index. Are we saying that now is a good time to buy dollars, or how should we think about like the selection on the US dollar base? And also, I suppose, given this chart up here, I mean, I can see I've got the contributor spreads up at the bottom right-hand side at least. UBS very, very bearish. And I mean, that's a fantastic research team. They're saying 2025, this is a 1-year out prediction. But you've got the standard chart at 1680, kind of the median spread is around that 1770 level. We kind of touched 1750 at the moment. But you can see there's clearly a strengthening trend in the currency locally. I mean, is it time maybe to hold more rand, or do you think that this is really an opportunity? I mean, again, during Liberation Day, we were almost at 20 to the dollar. So I mean, your view kind of on the idea of a dollar-based product.
Look, I mean, the problem with the rand at the moment is the fact that there's a number of uncertainties that are particular to the South African economy, especially like we mentioned the GNU, but also our very weak unemployment rate. We had one of our ministers coming and talk about a coup a couple of weeks ago. And obviously that's extreme. But the thing is that, most of you guys, you're South African based. That's why you're talking to Rand Swiss. And therefore, the majority of your assets are already in Rand. So you already have your house, your job, most of your pensions, etc., invested in the local currency, in the local market.
Normally yourself as well.
Yourself as well.
Which is probably the most important asset of all, the people that make the money.
Exactly. And so if you're having a choice of what to do with a little extra money, you want to probably put it into something that's not the rand. The second thing is this. If you look at the South African economy as a global percentage, it's less than 1% of the global economy. It's less than 1% of global financial markets. So if you are putting like half your money in South Africa, you are taking an incredibly concentrated bet on about 0.5%, when it comes down to, of the global economy. That is a very, strong bet to make. Think of it. You go to the roulette table, you put your money on zero. That is like 3% of the total, options out there. This is basically, 6 times more concentrated than that. And the thing is that the dollar, yes, we have seen issues with regards to a number of things that Trump has done, etc. But the thing is that the other guys are just, it's not a case of Trump winning. It's a case of basically the other guys, China, Europe, Japan, all have issues that are much worse. If you had to choose, which is the least dirty shirt, which is the least smelly pile of garbage, basically, it's by far the US. China has problems that are significantly worse than the US. Europe is even, significantly worse off than that, despite the positivity we've seen around things like, for instance, defense over the last little while. Japan, massive budget deficit. Recently, a massive rise in one of the right-wing parties there. South Africa, we know what's happening politically here. So yes, Trump is not the greatest thing in the world. And if I had to choose somebody else to be the leader of the US, I'm pretty sure I could find, dozens of candidates would be better. But the problem is that the US is still the best, horse in this race.
Still the best horse in the race. And I suppose, like you talk about a steaming pile of garbage. Yeah. I suppose that's also the problem, that if you look at cash, and I think, with the sell-off that we've had this year and with the Liberation Day tariffs, you do get a sense that investor nerves are frayed. People that have run heavy in equities, heavy in bonds into that sell-off, kind of were looking at the sell-off saying, oh, I want to take advantage of that, but opportunity maybe couldn't, or kind of have gone through that and kind of almost have increased, their cash allocation. And now suddenly looking at markets at all-time highs and saying, well, we're at all-time highs. I'm sitting on cash. I don't really want to deploy this into the market at the moment because, the time to deploy was during Liberation Day.
Yeah.
It was the 20% down. That's when you wanted to be buying. Now suddenly you're sitting on this cash. And unfortunately, cash itself is a steaming pile of garbage longer term.
Yeah.
Short term, very, very safe. Long term, very risky because it does tend to underperform inflation.
Yeah.
And that's why I think structured products, and we'll get into exactly how a structured product works now, but structured products are essentially that middle ground. It's not a high risk equity. It's not saying that you're going to be pegged to equity markets. We obviously linking to equity markets with the note, but with the capital protection that comes into it, you're essentially giving it's almost a hybrid bond equity product. So it's going to at least deliver you some return, but it gives you that kind of added safety as well. So it's something to do with these extra piles of cash that you're sitting on that really are garbage. It's something that gives you that alternative, which exactly works. So how do structured products work? A structured product is essentially a type of investment product that combines financial instruments like a bond and a derivative to create a specific outcome for clients. Typically the features of structured products are that they enhance returns over in a specific segment of the market. They generally have capital protection on them, and they can have both, depending on what you're trying to achieve. The basic building blocks of a structured product are a bond, which is essentially the very safe part of the structured product, and the derivative or the option that kind of creates the growth profile for you. And we can tailor these pretty much any way we want. You can do anything from income spitting out regularly to digital coupons that have uncapped growth, to growth notes, to there's we can do step downs where we actually reduce your thing, but we try to keep it quite simple with kind of, this is our headline structured product. We've been doing it for probably it's probably 8-10 years now, and it's one that works. It's linked to high developed markets, and it's a more simple version. But these can be, while we build them from very basic building blocks, they can create quite interesting and dynamic contingent payoffs. So the minimum size on doing it bespoke for you is probably around $250,000. We do tend to get much better pricing at around $500,000, but yeah, this is kind of an off-the-shelf product we're doing. But if you do have an appetite to look at something unique and you're looking to create a specific payout, we can do that as well. So why do you use structured products? Why, when markets are at record highs, would you consider a structured product rather than just diving straight into the market? Well, first of all, is the capital protection in volatile times. So if we do see things really starting to unwind globally, and in the next 5 years, we see that these are the major market indices are lower. If you had bought an ETF, if you had gone directly into the equity market, gone and bought an S&P 500 or a Euro Stocks tracker or a Nikkei tracker, you will be negative by that value. The capital protection in the note gives you the security to know that if in 5 years' time this is negative, you will get all your money back. It's essentially insurance on the portfolio. The enhanced return in flat or range-bound markets. So the enhanced return, like I said, you can create the payoff profile in a lot of different ways, but typically where you see these really benefit is in a flat or range-bound market. You don't want the capital protection to kick in. It's great when it happens. You don't want your house to burn down, but when your house burns down, you're very grateful to have something that gives that will give you a payout. But ideally, where does this actually benefit you? And where it benefits you is when markets have been, like I said, sideways range-bound. You just get a little bit of a kick up in markets. The returns have been suboptimal for a period, and this is where they really outperform, and they outperform the broader market, and they form a nice complement to a standard equity strategy. You can obviously access markets that you wouldn't normally be able to invest, and as I've said, you can tailor strategies to specific goals.
Yeah.
So let's get into the structured products that we have today. So like I said, we've got two which are pretty much the same note, except there's a few nuances, and there's a reason we've added the second tranche as well. So like I said, it's our standard product. We're looking at the S&P 500, the Nikkei, the Euro Stocks. These are three of the largest developed market indices in the world. And maximum duration of the structured product is 5 years. On our notes, remember, we always pass on the benefit of the note to you as the investor. So the capital protection at this stage, we marketed at 35 because we've just done pricing. Now we price out with a whole lot of different people. We've actually come back with a 14% coupon at 35% capital protection. So if we can get a slightly deeper capital protection on our strike, we give it through to you. It's not like we just increase the fees or anything like that. We literally, our fees or anything like that, we pass on all the value. Our fee is very clearly set out, which is essentially 3% plus VAT over a 5-year period, which is pretty reasonable when you compare
0.6%.
0.6% when you compare it to a typical active asset manager and the work that goes into structuring the product. But capital protection, 30%. We've marketed at 35 because we look like we're going to get 35% at the moment with a 14% coupon. That's on indicative pricing. But of course, we need to do a book build. So we need to get a gauge of the size and the interest from our client base. Once we've got the final numbers, we can start doing the hedge, and then we can get a much deeper certainty. If for some reason, let's say interest rates, don't play ball, volatility doesn't play ball either, and we can't achieve a 12% coupon on our strike date, we then come back to you and say we either will return capital or we'll kind of give you a second option. Say, listen, we can't do it on S&P 500, but we can do the same contract with a Nikkei at least with a Nasdaq contract, and that's going to get you to 12.1. Would you like to do it? So we'll kind of talk to you. Normally we have, like I said, we pricing at about 35 and 14 at the moment. So we do try to build in a little bit of fat, but remember, markets are very dynamic things. They're moving all the time. And as we do the book build, you will never get worse than this. And if so, we'll just kind of return capital or look at the next opportunity. How should we think about these? Essentially, the way that a triple index autocall works is you invest in these indices. You've got your 30% capital protection, and there's these observations. We generally delay we've delayed the observation for 1 year, and then there's semi-annual observations of where those indices are for the next 4 years after. So essentially, the way that you should think about it is you have 9 chances to win on this product, and it's the 9 observations that we're going to look. And when we talk about a triple index order call, all we want is those 3 indices to be positive at any of those observations, and you'll get your coupon. In this case, we're marketing at 12%, so it'll be definitely better than 12%, simple interest across the thing. So if you miss at observation 1, observation 2, which is 18 months away, it cashes and all indices are positive, you'll get 12 plus 6%, you'll get an 18% US dollar return, which I suppose if you put that in context is a lot better. I mean, that's actually better than the S&P 500 long run average.
Significantly better. I mean, the S&P 500 long-term average is below 10%. It's well below 10%. It's like about 8-9%, depending how you look at things. So we're talking about a return that's going to be above that with capital protection. And the other thing to understand here is that the reason that we have these 9 chances to win, as some of you might know, we've had a couple of periods in the last, say, couple of years, COVID, what's happened with the Liberation Day, a couple other things along the way, where we have seen the market pull back on surprising terms. If you are unlucky enough to get your money, basically paid out at that particular point in time, you could have been positive, and I've seen the case like this year, for the last year. It just so happens that your anniversary date is on the date of a, COVID announcement or something like that, there, or a week or two after the COVID announcement, and then the market falls like 40%. In that scenario, you've lost all those gains. Now, thankfully, this is a good thing, and I think Gary said we've been around for about 8 years, so 2017 till now, 8 years. We've never lost money for a client on any of these structures, and we've done many of them every year in the last, for the last 8 years. We've had 2, unfortunately, which have just returned capital. But even in the case where they return capital, the last one we had that returned capital was basically partly due to Liberation Day, partly due to the fact that China has been in a particular bad situation over the last few years. But in that scenario, the client still got in excess of a 20% return over 3 years. So effectively, they've got like in 20% after 3 years in rands. Why? Because the guarantee was in dollars, and the rand dollar rate has basically weakened over time.
Yeah, so just on that specific product, it was essentially the view on that one was it was literally an emerging market index, and the a growth note is a little bit different to an Autocall, but essentially you were investing in an emerging market index. If you had gone and bought an emerging market ETF and said, for a portion of my exposure, I want to have exposure to the emerging markets, and you had gone and bought the emerging markets, you would have finished 10% negative on the emerging markets. As it is, you finished positive. And that's where, even though it seems like a negative situation, that's exactly what you want your Autocall to do. That's what you want from a structured product, because and I don't mean to like harp on relative management, but if the market is falling and everything else that you own is falling, and you've got something that is returning cash, you also have the opportunity to buy into the market at much lower levels. You're actually generating outperformance, and if you continue to do that over a period of time, you will have an excellent investment return profile. So if you were looking at emerging markets, it was a better product than buying an emerging market ETF. And the benefit of that, on the upside, it was uncapped on the upside. So you would have taken all the upside on the emerging markets anyway. But like Viv says, that's a bad product. That's one we look at and go, oh, that's terrible. We didn't return so well. And you still get 20%, plus you still get your
capital protected.
Plus you still had your capital protected. So in terms of this offshore one, as I was mentioning, this is this one is actually a fully offshore product. So it's offshore domiciled. It's held by an offshore custodian. The deposit is in the deposit and the return is both in US dollars. That means that you do use your offshore exchange allowance to do this. So you need to use your SDA if you're moving it out. We had the currency chart up earlier. I think 1750, not a bad time to buy dollars if you're sitting on one. The SDA, obviously, you're limited to 1 million for the calendar year, but if you do need like what's called the AIT PIN, which is to use your 10 million allowance, we do them internally for you as well. These days, as long as we've got 3 years assets and liabilities, we can prove the source of funds. So the funds actually are sitting in one of our Investec CCM accounts. I think we got the last one turned around in about 7 days at SARS, and SARS normally waits 21 days before they'll reply to you, and we're getting them through very, very quickly lately. So there probably is even time to do an AIT PIN on one of these. Because, like, I don't know, SARS is very efficient these days, which is like hats off to SARS. Well done for getting these AIT pins sorted
Yes.
out.
SaaS is very good.
Yeah. But yeah, in terms of the minimum deposit, we're looking at the offshore note. It's, we bulk price. So like I said, pricing gets better and better and better. 250, 500, $1 million. I mean, we generally don't strike under 500,000 because there's a nice coupon lift between there. But yeah, anything over $1 million, we get we get even more aggressive pricing from the banks. But for you, we obviously passing on that scale. And you can invest from as little as $20,000. $20,000, you will benefit from the scale of the entire note. And obviously, the more people who are investing, the better the benefit is for everyone. Closing date is going to be the 11th of August, so we've got a little bit of time. Yeah, so it'll be pretty much 3 weeks away. So I've given you guys lots of time to have a think about it. We're also going to get to see what happens during the 1st of August. So if we do get a little bit of a pullback in markets as well, you're only going to strike in a couple of weeks' time. You'll strike at those lower levels. If volatility spikes a bit, we might get a boosted coupon, but we're going to be watching very closely over the next 3 weeks to start putting our hedge in place and making sure that we can get the optimal execution on the note. In terms of the offshore custodians, we've got 3 custodians we work with. We're looking at adding a 4th for this note as well, which at the moment it's DMA, Velocity, and Swissquote. All fees are obviously included in the note as well. So all the returns that we're talking about, this 12% dollar return, that's after fees, other than the execution. So certain custodians do charge an execution cost as well. So Swissquote, for example, will have an execution cost on their transaction, but that's the same as whether you were buying a share or selling a share. So
and a normal custody fee as well.
And a custody fee. So that's essentially the fees that are charged by your custodian, but it would be the same fees as whether you were buying Microsoft or you're buying an S&P 500 ETF. You face the same charges, but in terms of our fees and the asset management fees and the structuring fees, that's all embedded in the product. So those returns are all after fees that we're quoting. Of course, you are taking on credit risk when you're buying a structured note. So the way that we create this is we're going to a bank and we're saying we want this profile, and we actually farm it out to tons of banks. I've got it in the next slide. We farm to so many different banks, and we tend to try and also vary the banks as much as we can. So, because a lot of clients tend to build up a portfolio of structured notes, and what we want is we might get pricing from Morgan Stanley, then we have a Citi note, then we have a BNP Paribas note, but we like to try and vary the bank that's issuing the note, so that if any one of the notes in your portfolio does run into an issue from a credit point of view, it's only a component. Like I said, at the moment, we're getting like excellent pricing off off Nomura, but typically we do like to take an A-rated bank when we strike these notes. We pretty much have always used A-rated banks in the past. We've never seen a credit event, obviously, in any of these. In these notes, but it's worth just understanding that is a risk, and that's why we farm out to all these banks for pricing, and we try to vary who you're holding as well. I think to explain, I mean, I don't know if you want to run through this, but essentially this is, we've already talked a little bit about the observations, and I'm going to talk about it in the next couple of slides as well. But all you're doing is you're hoping that the 3 indices that we've selected, which is S&P 500, Euro Stocks, and the Nikkei, are positive over at some of the observations. And this is literally like the breakdown of the payoff profile. At the first observation, are all the underlying indices, so those 3 indices, positive? Yes, you get your full capital return plus the coupon for the year. If it's not, you go to the next coupon, you go to the next observation, and you keep running and it keeps doing that. If any of those observations trigger, you'll obviously get your full capital, you'll get your return. And the final observation, if something goes wrong with one of these 3 indices over 5 years, you've got the capital protection. But if it's below the capital protection, so if we're looking at a world in which the S&P 500, Nikkei or Euro Stocks collapses more than 35% over the next 5 years, that's where the potential downside risk is, and then it will trigger a 1-for-1 loss. So that's really where the risk on the note is. This is kind of where we are now. So this is the last 10 years worth of data on the 3 indices. I mean, you want to take us through what's going on?
Yeah, look, I mean, the great thing about these indices, they all pre-correlated. You can see they kind of follow each other's paths. There are obviously differences, but they do follow each other's paths. And why you want to be correlated is because you want all three of them to be positive at the same time. And so if you have like totally unrelated indices, what's going to happen is the chances of them all going to be, positive is lower. And that is obviously against what we want. The next thing to understand here is that these are the biggest indices in the world: Japan, the European indices, and the US indices. They're among the biggest indices in the world. These indices basically are much, larger capitalization. For instance, the JSE. They have much larger capitalization than, for instance, the UK market. So these are important factors to consider as well. You can find, other structured products that give you much higher returns. But in those cases, they're looking at, smaller indices, or they're looking even in some cases single stocks, which have a far higher risk profile. What we are trying to do here is we're trying to be cautious when others are greedy. And what do we mean by that? At the moment, we're seeing the market at all-time highs. We are giving you a product that gives you protection. So if the market does fall, 35% fall, 30% fall, sorry, in 5 years' time is a very big fall. It's worse than what we saw, for instance, in the global financial crisis. At the same time, if it does work out, we're going to get a return that's significantly above the average return in the S&P 500. That is a pretty stable kind of situation, such a good situation, sorry, to be in. But understand that it is possible that we could see some markets go ballistic. Let's say AI becomes, the really, really obviously positive, and the market goes up, say, 50% in a year because suddenly GDP growth rates are 20% every year. It's possible that happens. But it's less of a risk, I believe, honestly, when markets are at all-time highs, that you're going to see this huge move from here.
I think the way to think about it is here, is this a note that you want to sell out of your S&P 500 or your equity portfolio to go and buy this note? Probably not.
Yeah.
That's not, I don't think that's it. This is specifically for a moderate risk allocation. And I think where we've seen, the use case scenario, as Liv says, investing in all-time highs is not necessarily a bad thing. I mean, if you look at what happened during COVID, so this is 2020 over here, I mean, sharp fall, steep recovery. And if we in that period, yes, there was a little bit of kind of a pause and a consolidation, but you had a steady run afterwards. You could easily see a steady run higher. Now suddenly you're sitting on a cash balance, waiting for the next pullback that just never comes. You're going to lose out. At least here, you're going to get a comparable market-based return, but still have that security of the downside protection. Then, of course, you could go through a scenario where, we've had clients, because like I said, we've been doing this, since 2017. So we've had clients that literally invested 2022 in one of these notes. And I've actually got a picture on the next one. And you can see that was a grind. I mean, the markets were lower and lower and lower, and the recovery started to take some time. And, it was a very, very difficult period. And if we go and look at that specific scenario here, this is probably the easiest way to explain how the notes actually work. Let's say you invested on January 1st, 2020, and this is where you went in. Immediately, all the markets started going negative. And by the time we got to the first observation, which was 1 year later, remember, we delay the observation by 1 year. So we don't want you to cash in 6 months. We want to actually let the product run a little bit. And also, the pricing gets a whole lot better if we do that as well, even though the banks sometimes hate us for it because their margins are a bit lower. But essentially, you can see all three indices were negative at the first observation. So you go, oh no, now what's happening in the world? But the good thing was, we've still got plenty of capital protection. We've got plenty of time on the note to run. And we move now to the next observation, which is observation 2. Here we saw the Nikkei actually recover strongly positive in the Nikkei, but we had the Euro stocks kind of hovering, and the S&P 500 was the laggard. That was the worst index that was preventing the autocall from cashing. So all that happens is we roll across onto the third observation. Third observation, we've got the Nikkei positive, we've got the Euro stocks positive. S&P 500 was so close to being positive, but it didn't cash. So we roll to the next one. By the fourth observation, everything was positive, note cashed out, and you get essentially at this one, it will be 14% for the first year, 7%, 7%, 7%. For the period. Now, this is in the same period that when you do a point-to-point return, I've rebased this to 100, you were nowhere near the same kind of return. And you get this enhanced return because in a flat or sideways market, that's where this really pays out. If you had bought, so it worked.
And also remember, the Nikkei here, which is so positive, 30% up here, that's in yen.
Yeah.
In the same period of time that the Nikkei went up so much in yen, one of the reasons it did that was because the yen, moved dramatically lower against the US dollar. But the payoff that you got by being in the structure was in US dollars. So when you got paid out on the 20th of January 2024, number one, you got the huge return that we talked about, the 35% return, 7 plus 7 plus 7, 21 plus 14 in US dollars. And none of these indices in that period of time had come close to that in US dollars.
Yeah. So yeah, if we look at the backtesting scenario, like I said, even that was actually quite an unusual scenario. So if we take backtesting, all the way back, we see that, about half the time these notes actually cash in the first year. And that's the successful situation where you put in $100,000, you get your $114,000 back, and we roll it into the next product. Or you can, like, let's say, or you go, okay, I've got something else or whatever, you've got the option. It kind of creates liquidity for you, so you can reassess where the world is, you can reassess the markets as an investor. Or you can also take that and then kind of continue to compound it rather than use simple interest. And then, as you can see, it's just under 3% of the time that you might get capital returned to you. And it's actually, if I look at where the barrier breaches, I mean, there's a reason that we pick the barriers where we pick them, and with the indices that we pick as well. I mean, through the backtesting, we get 0% barrier breach. That's why the barrier is there. A lot of times clients do come and ask us for deeper capital protection. They say, I want 60% or 100% because they just feel like, I want this to be fully protected. I want it to be a bank deposit. You can do that. And I mean, we have done that for clients in the past. I mean, you're looking at probably halving your coupon. So I did one on a dollar-based index. Client wanted essentially 95% capital protection. Often it's very useful not to take the 100% because it allows you to say the capital is risk when you're submitting your tax returns, which kind of allows you to shift this from an income in nature product to a capital in nature product. So you'll see a lot of the guys are doing 95% capital protection. But the coupon drops from, at that stage, was about 14.5% in dollars to about 7.8% just for that additional protection. And I think that protection, I mean, Vivian, you can also talk us through this, but that is to an extent spurious anyway, because if the S&P 500 is down 98%, let's say,
the bank is bankrupt.
No, your bank is bankrupt. There's no market anymore. Every one of the 500 biggest companies in the world is bankrupt. We're fighting for our lives here. We're probably not alive.
But I mean, the idea that, I mean, if one of these big indices is down in excess of, say, 60% after 5 years, right? There has been occasions it's happened in the past, but those are literally once in a lifetime occasions. And people say once in a lifetime. It's like a once in a 70, 100-year kind of period that you will see that happen. In that scenario, had you invested in the underlying anyway, you would still get the same return. And and I doubt any of you guys, the worst you're going to get is the same return you would have had in the underlying index. You're not going to get, it went below 35% down, and suddenly I've lost all my money. If I had bought the index, I'd only be down 35%. No, had you bought the ETF or you've done the structure, if it goes below 35, the worst you're going to get is as bad as the index. That's what, when I say to clients, what's the worst case scenario here? It's not often like it goes down so much because it's the same as buying the thing. The worst case scenario from your own point of view is opportunity cost, where if this market goes up crazily and the thing doubled and you only get your 35% positive or 40% positive return, whatever it may be. That is the kind of scenario that you have to be kind of worried about. If it's not that scenario, then it's going to be the same return you'd get in the market.
Yeah, exactly. And that's why I see this more as like a replacement for cash balance than an equity portfolio. It's something that if you're sitting on the sidelines and you're nervous to dip your toe in, this is, you don't need, and I think I see that too much with client psychology. And maybe it's just because, like my background is in securities broking, that clients either want to be 100% in the market or 100% in cash. And they're going from one side of the risk spectrum to the other side of the risk spectrum. And they suddenly 100%, it's like flat out, we're in sixth gear with our foot flat on the accelerator, or we're slamming on brakes and we're parked. And I mean, that's not how you should be allocating capital. You need to have that middle ground, and this gives you that middle ground where you suddenly can go, I'm nervous of markets, but I still want some return from this. I don't want to sit and get 2% on dollars overseas. I'm willing
But
to
pay interest, so pay taxes.
and pay
Income tax. Yes.
pay income tax on it rather than capital gains tax. So this is for that it works phenomenally well. Now, so that's the back testing. That's our note. We like it. We've done it a lot. It's works well for us. In terms of, we've also got the NetBank equity linked note. Now, this note, like I've included in the presentation as well, and there's a specific reason for that. Now, their indices are identical to us. So they're also picking highly correlated developed market indices that represent the biggest, strongest companies in the world. The kind of things that this is not, we're picking some robotics startup and hoping that we're going to do this for like a 30% coupon. These are the biggest, most secure indices in the world. They've done the same thing. The duration on theirs is 2 years shorter. Now, that means that you have essentially 5 chances to win. They also delay by 1 year, and they also have semi-annual observations. So the whole thing works exactly the same. Now, for chopping off those 9 extra chances and for dropping the capital protection to 30%, what you're getting is you're going to get a coupon lift. So they are going to give you 15% in US dollars. As long as the 3 indices are positive. So it's very similar looking to us, a little bit shorter duration, which is helping to boost up the coupon, and a little bit less capital protection, which is also boosting up the coupon. I don't think it's to me, like I would rather have, I keep on saying it, it's like I'm getting really conservative in my old age. It's like I'd rather have more chances to win than a higher coupon. I don't want to make as much money. I'd rather make it safely. I mean, I never thought this would happen to me.
This is no chance to win. I would say 5 years is a lot longer to recover than 3 years.
Yeah.
If there is a pullback, for instance, you look at 2008 and there was a 3-year pullback, a 3-year structure, 3 years might not have been enough for the market to recover. 5 years was more likely to be enough for the market to recover and pay you back your capital protection.
But at least like with the 3-year recovery, it's still not a bad, like I said, it's still not a bad thing because you might get your capital return, but the markets will also still be down and you can then go into markets. So it's not, like I said, capital protection triggering on these notes is not the end of the world. It's actually a good thing. If all of these indices are down 20%, you get all your money back. You can literally take that money and buy all the indices 20% down. I mean, what a pleasure. But this is not why we're looking at it. It's just these are the terms that are slightly differently. Unfortunately, their terms are also set as a South African bank. The only reason that we've managed to get this is actually my old relationships with NetBank. So we're going straight through the CIB desk to get it for you guys, and it is kind of a unique issue. And this is why we like it, and this is why we're doing it. So essentially what NetBank's going to do is it's going to wrap this note up in a local note, and it's going to be listed on the JSE as well. So it's going to have a JSE share code. That means, firstly, you can just stick it in a JSE share trading account. It's not complex. And the most important thing is we don't have to take money offshore. So we talked a little bit about AIT pins and offshore allowances. If you've got dollars overseas, I'd say first note is for you. If, however, you specifically want the funds to remain in a local instrument, but you want that offshore exposure, this note is much more appropriate. Now, when I say that, who is that? That it is ideal for South African trusts and South African PTY limited companies because they don't have an offshore allowance. You can invest internationally, but you've got to set up an asset swap, which is expensive. Here, you can put a fully offshore instrument that has an offshore payoff profile, that the principal that you invest in the note is going to be converted into US dollars at what we consider, I think, a fairly decent rate at around 1750. And as you go into the note, you're going to get all the benefit from a weaker currency if the currency weakens, and you're not going to have to pay asset swap fees to try and create an international structure for a local company that will eventually have to be returned to South Africa. So it's a lot lower cost mechanism for South African trusts and South African companies that struggle to get money offshore. And like I said, from the basic idea behind the note, in terms of the indices that they're selecting, in terms of the depth of the capital protection, we're happy with it. So that's why we're including it today. It's also, so one of the reasons that we also set our closing date on our note at the 11th of August is it ties in. So you basically have two options here. If you want to invest in our note directly offshore, you just say, cool, and we can buy it for you. If you want us to pick you up the Nedbank note, which is a locally issued instrument, which, like I said, SA trusts, SA companies, this is, you are the guys who should be listening. This SA note might work well. 11th of August, the Nedbank one, we just have to do an application form. We can't just do a dealing instruction like we normally would. And then also, obviously with this, you're adopting Nedbank credit risk. So that's, I suppose, the other difference between the two notes. Now, Nedbank is a AAA rated bank by Moody's. .ZAR. What does this mean?
That means basically, look, in terms of South Africa, that's the ZAR part, ZA. You can't build a house on a foundation that's weaker than the house, basically. A house can't be like an A-rated house and the foundation is going to be a B-rated foundation. Why? Because the house depends on the foundation. The foundation for these banks in South Africa, unfortunately, South Africa's credit rating has not been, globally AA rated. So obviously these banks are going to have that issue. But in terms of South African, institutions, they are up among the best, AAA rated among the South African institutions.
And what I'm going to say as well is like the way that Moody's and S&P would think about Nedbank as a bank is they think about Nedbank like, oh, it's some dodgy bank down at the tip of Africa. And if you actually look at the quality of the South African banking system, I mean, we continually rate, among the highest in the world. There's nothing wrong with a Nedbank or a Standard Bank. I mean, like South African banking institutions are incredibly well capitalized. I think their stocks are also very, very cheap. But I don't think, like, from a credit rating point of view, it's an A-rated South Africa, which wouldn't give it an A rating in the international, by international standards. But I think, given that we are all South African investors, the benefit of the ability to invest in South African trusts and South African companies directly in the note, and the fact that that I think we understand these banks well. I mean, I would be comfortable, taking on Nedbank credit, because I don't think Nedbank is going to be an African bank, if you put it that way. I think that there are a lot more
like African Bank Limited.
African Bank Limited, which, like, ABLE was the share code, which ran into problems. And even then, bondholders took a 90-cent haircut on the rand.
No, took a 10% haircut, took a 90% back.
They took a 10% haircut, but it was 90% payback on the rand at least.
Put it this way: would any of you guys, if I give you R1 million right now, be unhappy putting that R1 million into Nedbank as a fixed deposit for 5 years? If you are happy to do that, understand that obviously if Nedbank has a credit event, that most of that money, 90% of the money basically, would be under risk, because there's only about 100,000 or so that's just covered by the deposit guarantee, right? And therefore, if Nedbank went under, you'd have a chance of that 90% being at risk. But does anyone actually think of Nedbank as being that kind of risk in South Africa? When it comes to risk profiles, like Gary mentioned, it's all about the lack of information. That's what risk means. You don't know what's going to happen. I do honestly believe that in South Africa, we as South Africans understand South African banks better than S&P and Moody's understand South African banks. We have a better feel for them. And therefore, if I had to open an account at Nedbank and put like R1 million into it, I would not be every day watching and making sure that Nedbank's basically credit rating was going up or down. I'd be pretty comfortable with it. And the same kind of thing applies here, quite frankly.
I think you've got to be comfortable with Nedbank, which I think we are. And like I said, quite a simple product. I suppose someone else that the minimum deposit is. It's similar, but I put the minimum deposit up at 250,000. I think that is also more permeable on that as well. So we can probably go lower on that. I think so. If also you're looking for a lower entry point than a $20,000 entry point, the Nedbank note could also be an option for you in terms of doing that, because you're not going to have to do an international transfer. The whole thing is a little bit simpler to execute. So we could probably look at that minimum deposit being a little bit lower as well. So I think the accessibility around the note is also a little bit better. And that's kind of, I've got a couple of payoff scenarios. I think we've talked around them already. So we're kind of early this time, which is unusual. It has been a long week. It's been a long couple of
weeks. You have a cold, so.
But I don't know. We've got a couple of questions on the line. If you do have any questions around the note, just let me know, and we'll answer what we can. What are your thoughts regarding the next 5 years? Will the US dollar continue to dominate as a global currency? I think that's a good question.
So the only alternative you have, quite frankly, is the Chinese yuan. But here's the thing: money only matters where you can spend it. For instance, you could be a ruble billionaire or I don't know what the North Korean currency is, but you could be a billionaire there. But you want to go live there? No. Given the choices where you really want to spend your money, you want to spend your money in the US sphere. You want to go to Europe, you want to go to the US, you want to go to Japan, Australia, those places. The Chinese sphere, it may be possible that in 5 years' time, the Chinese really get their act together and are like really challenging for dominance of the US currency. But from your own personal point of view, you much rather have dollars than have yuan. Okay, and so yeah, I think from your personal point of view, you still want to be holding US dollars above any other currency in the world, with the possible exception of the euro. But the euro and the dollar basically is fluctuation between the two. But it's not. I mean, right now the dollar is quite weak versus the euro. It's not a bad level to get into the dollar versus euro.
Yeah, I mean, we had a big debate about this also in the presentation at the beginning of the year. Like I think a lot of it is also in the market pricing. So will the US, it is still a reserve currency of the world.
Yeah.
I think there's been a lot of attacks on it. And I mean, I think the US is pushing back hard. That's one of the reasons that we have tariffs and the whole kind of aggressive stance of the White House at the moment is because there was mention of like, let's start a BRICS currency. Let's try and kind of hamper, US dollar dominance across the world. And the result has been the US has pretty much hit back at every economy in the world and said, do things this way. I mean, there was obviously the announcement that, a BRICS currency BRICS is anti-American and Trump would levy additional tariffs on anyone that was considering it. So it's, I think the US is certainly fighting for their currency. Now we have seen weakness because I think it's just been a given for so long. It's so long it's been like, it's US dollars, it's the reserve currency of the world, of course. And I think the fact that the US is standing up and fighting for the dollar as the reserve currency of the world at the moment, that is kind of almost where the fear is coming from. That's where we've seen a little bit of weakening in the dollar. It's the, wait a minute, is this so much of a safe haven asset as it was in the past? And I think we've seen that relationship breaking down over the last, certainly the last 6 months, where the US dollar, if you look at like typically the middle of Liberation Day tariffs, you look at like the big panic sell-offs, even the small, days where you have a kind of a panicky headline, you see the yen going up, you see the franc going up, you see gold going up, and you see the dollar going down. It's kind of behaving almost like an emerging market currency a little bit. And I mean, that is fair, but it is still the US dollar.
Yeah.
There's no question. It's still the biggest holding of central banks globally. Like it's
and also I mean, the Chinese are growing sometimes faster, but you don't know exactly what the Chinese thing is. But the US economy is by far, I would think, the strongest big economy in the world. All the new technologies are focused in the US, etc. And one last thing I'll put here is like it takes a lot to lose reserve currency status. The British pound took a couple of world wars. Well after they were nowhere near the most powerful economy in the world, the British pound was still effectively a reserve currency for the planet. And it takes a lot for people to switch away from the US dollar towards the Chinese yuan, especially when you consider the fact that the Chinese monetary system is much more unstable in terms of not just saying in terms of credits and debits, but in their vulnerability to their leadership. Trump can do a couple of things here, but right now he's fighting with his Reserve Bank governor. Xi Jinping does not fight with his Reserve Bank governor. He says, do this. The guy says, okay, yes, sir, how quickly, when? That is how it works. And it's a very different situation.
Yeah, I think that's a good point. And also, I think the mechanics of how the global financial markets work at this stage, like we often get questions and clients that come, I need to do this in New Zealand dollars, or, can you find me a good ETF in kind of like one of the more obscure currencies? It's just the plethora of financial instruments and investment options that are available that are dollar denominated is so wide that often, if I look at our client base, once you've essentially invested in a product, often you're kind of, I mean, in this case, not because you still have the dollar risk, but when you go and buy Microsoft shares, for example, we don't really care so much what the dollar does because we own Microsoft shares. If the dollar depreciates, Microsoft shares get more valuable in dollars. If you go and buy gold, with your dollars and you have a dollar balance, and even though it's referenced in dollars, you've got the asset that you're buying. So in most investment cases, and the thing is like, just key to continually switch currencies. And I mean, we've got, like specifically at Swissquote, I think you've got 13 reference currencies that you can have in the account that when you tap your card, it will literally, so euros, Aussie dollars, all of that you can debit. And I mean, Swissquote has pretty much every instrument. I mean, they've got like 3 million different instruments, but it's just like a lot of instruments just aren't created in other currencies as well. Like,
Yeah.
and the problem then with, us launching this as, let's say, a franc note or, or a yen note or like an Aussie dollar note is, one, a lot of clients are going to be facing currency translation. Like we're going to have to kind of convert everything into Aussie dollars to take the note, for example. And then also once it comes out, you're going to have to convert them back to US dollars, because when you're looking around for the next financial product or the next investment, it's like the vast majority of them are dollar based. And it just makes sense whether you're investing in a fund, generally the dollar classes are better. So I would, you're buying the same assets, but if you buy them in dollars versus pounds, it's more efficient.
Yeah, I mean,
so you kind of, if I had a choice, and like I said, the Swissquote accounts are unique because you've got 13 reference currencies and your card will link to all of those. And you actually have, you can pretty much put any currency in that account. I mean, even if it's not a reference currency, you just can't tap your card for it. But if I think like, what is my account denominated in? Dollars. Like, why would I put it in pounds or euros or that? It's just like everything runs in dollars. Like the whole way that I think about the financial system runs in dollars. So it's not something that it's weird. I wouldn't have even considered like, we should do the
But here's one more thing. I mean, understand there's not a very well traded market between the Aussie dollar and the rand, or the Aussie dollar, or the rand and the yen, for instance. What actively happens in the banks is that when you do a transaction between, say, the rand and the yen, what happens is you convert the rand to dollars, the dollars to yen, and that is the gap you cross. You cross two gaps. You cross the gap between us and the dollar, and then the dollar to the yen. And that is the thing that you do for almost all currencies in the world. There's very few currencies that interact directly with another currency out there. The euro might be up there, but the majority go to the dollar first. Even to a certain extent, I mean, the Chinese yuan was pegged to the dollar for a very long time. So understand that the dollar still remains, not just because of US strength, but also just because of what people are used to doing. And the markets, the liquidity of the markets that are involved. It might change in 20, 30 years' time, very unlikely to change in 5 years' time.
Yeah, no, it's a good question. So we got another question, Gary. Can the payout at maturity be in your offshore account since you've used your yearly allowance? Of course. Yeah. So once you've obviously crossed the border with your currency, once you've used that allowance, the funds are out. Like if you're sitting in one of our Swissquote accounts or a DMA account or Velocity as an offshore account holder, those funds never have to come back to South Africa. That's the big difference between using the asset swap or like a feeder fund or something like that. There, the money's not really out. Here, once you've externalized through exchange controls, the money never has to come back to South Africa. In fact, if you've taken out, let's say that over the last couple of years, you've taken out, $1 million a year and you've got 5 million outside of the country sitting in an offshore bank account. And this year you need to do a renovation on your house or something, and you bring back R1 million to do a renovation. That actually, it's called funds in, funds out. It actually tops up your allowance. So this year, if you haven't used your 1 million rand STA allowance and you've brought R1 million back in, you actually have 2 million available to get out as well. But in terms of this product, you invest in it offshore. When the coupon gets paid out, it gets paid out into your offshore account. Generally, we'll have a roll product for you. We always kind of create a product around the time of an expiry as well, just to kind of give guys the option to kind of generate the compounding. But yeah, no problem. Definitely going to be paid offshore.
And another thing to understand as well, the benefit of going offshore directly is this. You get taxed on your currency change. So if it goes up 10% in dollars, well, you get charged 10%. If it went up, say, 10% in dollars, but the rand also weakened by, say, 50%, so there's a 60% movement, for instance, then you get taxed the 50% plus that 10% becomes your gain. So yeah, if you believe that the rand over time is going to be weaker versus the dollar, the dollar-based one is better.
That's on your principal though.
Yeah.
Okay, so what costs will be incurred with the AIT process, and how do I get started? Okay, so AIT PIN process, really simple. So how you get started, you just pop us an email and we take it forward. So like I said, we do them in-house for active, when I say active clients, like for clients that are working with us, we don't charge for them. We just ask you to do your currency transactions with us. I mean, obviously, if you come to us and you make us do an AIT AIT PIN, and I mean there is quite a lot that goes into it, and we kind of offer it as a pro bono service to clients. It's a value add. We're not going to go, there's your bill. We just say, you must be one of our clients. You can't just come and exploit us for free work, because then we're also not really interested in just doing AIT pins for people and then shipping off the money. I mean, we want to kind of build relationships. It is a value-added service. We're a wealth management firm. It's not kind of like an ad hoc service that we would offer. But for clients, it's free. And all you really ask is, do your FX transaction with us. And
if you don't do the transaction, just buy the product with us. So if you had to do the transaction with somebody else, but you did bought our product, I think we'd be okay with that as well.
100%. No, that's also fine. Like all we're saying is like, make it fair. If we're going to run around and do your tax work for free, don't go, thank you very much, I'm going elsewhere, and disappear. The answer is it's free, but you have to be a client.
Yes.
We're not doing free work for non-clients, put it that way. Thanks, guys. And that takes us just before the end. If there's no more questions, we will put this up on YouTube.
No, is that Q&A? Okay.
That's it.
Okay.
All right. Thanks a lot, everyone. We'll see you in the next one.
Okay. Cheers, guys.
Bye-bye.